all during the bull market, actually since the 2015 low, but especially over the last year, the staircasing process, we had 3 steps up for gold, 1 back, or for silver, it's like 4 steps up and 2 back, will end. And that we're going into a more accelerated phase.
You're watching Silver News Daily. Subscribe for more.
We argued that the pause, which is what we defined that period as, not a topping action, was over and we're going back up again. Okay, so it's March of last year. Gold was just above 2,000 again. It'd been there 3-4 times before, but this time was different. Silver was 25 to 26. We since seen 35. And GDX, for example, the gold mining ETF was 31.5. It's been up over 40. It's over 40 today. But during that surge of the last 11 months now, there have been multitude of pullbacks in gold where I don't pay too much attention to internet chatter. My son does. He tells me what's going on with the popular opinion. And it seemed like every time gold would do that, yeah, it's the top. Oh no, or we're going to have to correct for 6 months and, all this stuff. And if you go back in the weekend report, I put an arrow in each of those spills, the little drops that gold had. And there was one of them that was 9% and one was over 6%, but most of them were about 5 or so percent. The one we just had last week, from last week's high to last week's low, which is the peak to the low so far, was 4.3. And yet people have still said, oh, that's it, 3,000 was it, we can't get through there. If you look at the price chart even, and look at prior highs, when gold makes a high, even the prior highs during this last year where it drops, 5-6% or so, and it takes maybe a month or 2 to get back up. This one had 3 weeks in a row at the same high. I mean, within a few dollars of each other. You don't top that way. If you're going to top that way and create a correction, you create a spike and then you drop. Okay, you don't keep coming back to the same level. And so obviously, there was a crowd of folks saying, okay, 3,000 is a big round number. I'm going to sell just short of it and risk a nickel and make a dime. Okay. Well, they risk a nickel and now so far they ain't made any money. Okay. We think that probably was it. It was a protracted daily decline actually for momentum, even though for price it was like a 1-week phenomenon. But I think that's probably over, that last dip, false top. And you get back to the highs again. They're gonna. This time, I think it's going to be different, in that the process we've seen all during the bull market, actually since the 2015 low, but especially over the last year, the staircasing process. We had 3 steps up for gold, 1 back, or for silver, it's like 4 steps up and 2 back. Will end, and that we're going into a more accelerated phase. So that's what I see happening here, and I think it's going to be coincident with the breakage we're already seeing in the stock market. It's already commenced with the S&P. Some other key markets around the world, the Sensex in India is a bubble as well. It's broken. It's our quarterly structures. And the Nikkei 225 has. So we've got 3 major markets around the world, which are all would be qualified as big bubbles, given the multiples of gains of it since 2009. And they're breaking structure. The only one we're waiting on is that NASDAQ 100. And it's dancing around the number right now as we speak. And I just want to close a week below it. And so we'll see. Last week got below it in 15 minutes to the close on Friday. They zoomed back above our number as if they knew. So anyway, we think the stock market breakage is more fuel for gold. Not what most people think, which is, oh my gosh, if stocks go down, gold goes down. That is not a good truism at all.
Silver is standing at the edge of a financial supercycle, and almost no one sees it coming. Michael Oliver, one of the sharpest minds in market analysis, is sounding the alarm. Stocks are on the verge of a meltdown, but while Wall Street braces for impact, another market is gearing up for an explosive move. Gold, silver, and the entire precious metals sector are entering hyperdrive, fueled by forces that most investors are completely overlooking. Think about this. Every time we've faced a major financial crisis, gold and silver haven't just survived, they've thrived. But this time, the setup is unlike anything we've seen before. Central banks are hoarding gold at record levels. Silver demand is surging from both investors and industry, and now with inflation raging, debt soaring, and fiat currencies under pressure, the writing is on the wall. But here's where it gets even more interesting. Miners. The last time silver went on a major bull run, mining stocks didn't just rise, they skyrocketed by 500% or more. And right now, they're sitting at levels that could set up the biggest gains of all. The mainstream media won't talk about this. The big institutions don't want you to see it. But the smart money is already making its move. So what's really driving this? Why are gold and silver about to break out in a way we've never seen before? And most importantly, how can you position yourself before the window closes? Stay with me, because by the end of this, you'll know exactly why this moment could define the next decade of wealth creation.
And that's very important. So if you're in gold, don't just look at gold. Look at the stock market. Look at the bond market now, which is saying, yep, there's some scared money starting to move out of the stock market. It's important stuff. Dollar index, for example, has been dormant as heck for 3 years now, basically in a monthly peak close to low monthly peak, low close, about a 7% range for 3 years. That's like a sleep. So major Forex has not been a impact factor in other markets. But right now, the dollar index is about 2% above a level that if it drops down to and closes a month at, we're going to blow an annual momentum trend structure that goes back a couple decades. Meaning our momentum work says, the floor is coming out. And suddenly at that point, you're going to have another major asset category become a wave creator. And it will be a wave creator that hurts many of the foreign investors who've piled into the U.S. stock market. Because when they bought through dollars to buy their stocks. And suddenly they get hit by one, stock market dropping, and two, the dollar dropping. So watch that factor. And that will impact gold as well.
For years, the stock market has defied gravity, soaring to all-time highs despite mounting risks beneath the surface. But Michael Oliver and a growing number of financial analysts are warning that this ride is about to come to a screeching halt. The warning signs are everywhere. Skyrocketing debt, rising interest rates, a bond market in turmoil, and a Federal Reserve walking a tightrope between inflation and economic collapse. Every major bubble in history has ended the same way, with investors believing the party will never stop right before everything comes crashing down. Look at the debt crisis unfolding right now. The U.S. government has pushed its debt past $34 trillion, with trillion-dollar deficits piling up year after year. Interest payments alone are devouring federal revenue at a pace never seen before, and the only way out? Print more money. But here's the problem. Every time the Fed prints, inflation spirals out of control, eroding the value of the dollar and pushing investors toward hard assets like gold and silver. This isn't speculation, it's history repeating itself. In the 1970s, during runaway inflation, gold shot up over 2,000%, and silver followed with a nearly 3,700% explosion. But today's crisis is even bigger. The entire financial system is built on cheap credit, and with interest rates at multi-decade highs, cracks are forming. Real estate is slowing, corporate bankruptcies are rising, and Wall Street's biggest players are quietly rotating out of stocks and into safer assets. That's why central banks are loading up on gold, why silver demand is hitting record levels, and why smart investors are moving before the crowd catches on. The stock market has had an incredible run, but gravity always wins. And when the collapse begins, history tells us exactly where the money will go next. But here's the key. Gold and silver aren't just hedges against crisis. This time, they're set to do something even bigger.
Crash. In 29, we had a crash coming off the high. In 87, there was a crash that did not lead to a bear. And there's reasons for that. The annual momentum was not broken. It was just the quarterly. In our case, we're going to have a nightmare situation as we have both annual and quarterly in jeopardy. But the point is that it's rare to have a bear market that begins with a crash. Most of the bear markets you go back and look at in the stock market, like in the mid-70s to the 74 drop, it was late in the bear market where suddenly you had a crash type event. And by the way, during that time, gold was exploding, okay? 74, gold was going off the page, stock market was imploding. So don't forget that. The dot-com high, there was no crash. NASDAQ 100 dropped 82% over 2 years, but it wasn't a crash, meaning a crash is like 30 to 35% in a matter of a couple of weeks. Like that's what happened in 29, it's what happened in 87. And also the COVID event was a crash type event. But don't expect that this time. I see enough reasons to see layered decline in the market. Oh, decent drops, but not what you could call a crash. And in the past, you get those kind of events. It's not going to impact gold. It's fuel for gold. Why? Because two reasons. Money in the stock market, which we know is enormous, will seek a new place. It doesn't all get burned up in the fire. Okay, smart money starts to move. It's already begun to move. It's pretty evident. And where does it go? You go back as far as you want. It goes into gold. Well, you have a stock bear market, and it goes into T-bonds. And this time, I think T-bonds are already indicating something's going on because they're going up, and it's not because Fed's cutting rates because they don't control the long end of the market. But T-bonds are rallying while the stock market is getting nervous. In our terms, actually breaking stuff. And gold has been rising. So money is already flowing there. The question is an acceleration in that money flow. And that will occur once you knock them in the face once or twice. And we think the first drop in the S&P will be about a 20%er. In other words, if you look at an S&P price chart or a NASDAQ 100, I go back to the 2021 or 2022 highs. NASDAQ 100 peaked in November 2021 and then had its drop. S&P peaked in early 23 and had its drop. You go back to those highs, that's about 20% off the recent highs. And I think the price guys are going to want to buy that old high, thinking, oh, let's support. And we've got momentum reasons to assume that there might be temporary support there. So what we're arguing is, yes, even if you break our key numbers, which most indices have done, except the NASDAQ 100, which is the leader, we think there'll be a slab of decline, the kind that upsets people. No, it's not going to terrify. It's not going to be a crash, I don't think. It'll be a layered process like most bear markets are. But even a 20% jolt, if you're an average Joe out there and there's one thing that makes you smile over the last year, not consumer prices, not your mortgage, not, et cetera, not your credit card debt, but your retirement account. Oh boy, it went up 20% last year. If all of a sudden you shave about 20% off that thing.
Gold and silver have always been the ultimate safe havens in times of financial turmoil. When markets crumble, when inflation eats away at the value of cash, and when trust in the system collapses, precious metals are where smart money runs for cover. But this time it's different. This time gold and silver aren't just reacting to crisis. They're setting up for a breakout unlike anything we've seen before. Take a look at what's happening behind the scenes. Central banks around the world aren't just buying gold, they're hoarding it at a record pace. In 2023 alone, they purchased more gold than any year on record, signaling that the institutions controlling the global financial system no longer trust their own currencies. Meanwhile, silver is seeing an unprecedented surge in demand, not just from investors, but from industries that rely on its unique properties. Historically, when gold moves, silver follows, but with even greater force. The last time gold hit all-time highs, silver didn't just keep up, it exploded, outpacing gold's gains by multiples. In the 1970s and 2011, and in every major bull market before that, silver has acted like a slingshot, lagging behind gold at first, only to surge past it in the final stretch. Right now, we're seeing the same setup unfold again. But here's where it gets really interesting: the supply side. Unlike gold, which is mostly recycled and stored in vaults, silver gets consumed. It's used in electronics, solar panels, medical devices, and electric vehicles, making it far more vulnerable to supply shortages. And with silver inventories on COMEX reaching record highs while physical silver becomes harder to source, a disconnect is forming, one that could send prices soaring. This isn't just another gold bull run. Silver is setting up for something even bigger. The question isn't whether silver will move, it's how high it will go when the market finally wakes up. And the signs are everywhere that the breakout is closer than most people realize.
If you go back in history, you'll find that is a rarity, okay? In the weekend report we just issued, we did some studies going back to that 2007 to 9 period, which is what everybody's got burnt in their memory. Yes, there was a month in that bull trend in gold which remember had begun from a 2001, 2002 low, down around $260. So it was already in process upside. But in that 2007 period, like spring to the fall, yes, gold weekly price was somewhat in sync with the ups and downs of the S&P. And then we showed that when the S&P made its final peak in October of 2007, 1 month after the Fed began surprise rate cuts, by the way, gold was still somewhat in sync in these little weekly moves. And all of a sudden, there was a sharp break in the S&P from a November high to the January low of 2008. And at that point, when it really counted, gold shot up. So there was all these seeming linkages that you could see suddenly went sour in a big way when it really counted. In other words, when the big move occurs. And yes, during 2008 in October, a full year off the stock market's peak, the stock market produced what you could call a crash type month, 30+% on the downside in a matter of weeks. It was in October of 2008, a year after its high. Gold participated in that 1 month cataclysm and immediately reversed, and within a few months was back to its high again, while the S&P continued down until 2009. So yes, you can find a month during that 10-year bull trend in gold, 10, 11-year bull trend, where, there was a month they did the same thing. But if you believed that and got out of gold, you missed the entire move. It went to 1920. Well, the stock market took until 2013 before the S&P could ever get back up to its 2007 high. So, gold, meanwhile, had gone off the page during that time period. So, yeah, don't make the mistake of finding points of linkage that you think are truisms, because over time they don't work out.
Silver isn't just a monetary metal, it's an industrial powerhouse. Unlike gold, which sits in vaults and central bank reserves, silver is actively consumed in the real economy, and demand is accelerating at an unprecedented rate. The world is going green, and silver is the irreplaceable metal fueling this transformation. The numbers don't lie. Industrial consumption of silver is at record highs, and the market isn't prepared for what's coming next. Look at the solar industry. Silver is a critical component in photovoltaic cells, and with governments around the world pouring billions into renewable energy, demand is surging. The International Energy Agency projects that solar panel production will skyrocket over the next decade, with silver consumption in the industry expected to rise by more than 50%. And here's the kicker. Unlike other metals, silver has no viable substitute in high-efficiency solar panels, meaning the demand floor keeps rising while supply remains tight. But it doesn't stop there. The electric vehicle (EV) revolution is another major driver. Every EV on the road contains up to 50 grams of silver used in batteries, charging stations, and electrical connections. With automakers shifting toward full electrification and governments pushing aggressive net zero targets, silver demand from the EV sector alone is set to explode. Add in 5G technology, medical applications, and aerospace advancements, and the picture becomes clear. Silver is not just a safe haven asset, it's a necessity for the modern world. Here's where it gets interesting. The supply side. Unlike gold, silver isn't just hoarded, it's used up. Once it's embedded in solar panels, circuit boards, or medical devices, much of it is never recovered. And with mining output struggling to keep pace, a structural deficit is forming. The silver market has already been running supply deficits for 4 consecutive years, meaning more silver is being consumed than produced. This sets up a perfect storm. When investment demand collides with industrial necessity, silver prices don't just rise, they go vertical. And right now, the gap between growing demand and limited supply is wider than ever before. The question isn't whether silver will surge, it's how soon the market will wake up to the reality of this supply crunch.
Yeah, I've got some friends who are fundamental analysts, names who speculated they could go based on certain metrics they look at, not technical, go up in the 20,000s. I don't know. We're not projecting a given target. We're just saying there will be an acceleration phase. There certainly was in the move to 1975 high, then the move up to 1980. There were phases in the last year of the move where suddenly it changed. It was no longer normal action. It was abnormally upside. And we haven't had that. We've gone to 3,000 in layered, cautious staircasing process. And I think that's about to end because factors will shift. And the main one, again, is the stock market. And we know that the other factor, aside from money flowing out of that market, will be central bank response. We know that the Fed, the ECB, the BOJ, and any other central banks will panic. And once they panic,
Silver's supply crisis isn't just a future problem. It's already here. While demand from industry and investors surges, silver production is struggling to keep up. And the reason is simple. Mining silver isn't as easy as it used to be. Unlike gold, which is often mined as a primary resource, silver is mostly extracted as a byproduct of other metals like copper, lead, and zinc. That means silver production is tied to the profitability of these other industries, making it vulnerable to supply chain disruptions, declining ore grades, and shifts in global mining economics. Right now, silver miners are facing major hurdles. Many of the world's largest silver-producing countries, Mexico, Peru, and China, are seeing declining output due to environmental regulations, lower discovery rates, and operational challenges. In 2024, global silver mining production barely increased, while demand continued climbing. Meanwhile, COMEX inventories have reached record highs on paper, but here's the catch. Most of that silver isn't actually available for delivery. Much of it is spoken for by industrial users or held in long-term reserves. Meaning the real physical supply is far tighter than the numbers suggest. But the real game changer? Recycling can't close the gap. Unlike gold, which is easily reclaimed from jewelry and electronics, silver is used in such small amounts across so many industries that much of it is never recovered. Solar panels, medical devices, and electronics consume vast amounts of silver, and once that silver is used, it's gone. This creates a long-term structural deficit. More silver is being consumed than is being produced. And the gap is widening every year. And here's the most explosive part. When silver supply tightens, prices move fast. We've seen it before. In the late 1970s, a supply crunch helped send silver from $6 to nearly $50 in just a few years. In 2011, a similar squeeze drove prices up 400%. Now, with global silver deficits persisting and demand reaching new highs, we're setting up for another historic move. The market is still asleep, but when silver breaks out, it won't just climb. It will skyrocket.
I think it probably has topped. The question is to get a sufficient break to where we're confident. And I'm telling you, the NASDAQ 100 is trading above and below our key number last week. And even, if you close much down this week versus last, you're going to break our number, in which case we think the process is really underway. Because again, NASDAQ 100 is the leader. While the S&P went up ninefold from its 2009 low to recent highs, NASDAQ 100 went up 18-fold. And just like the dot-com process, when it broke, it was the leader then, internet stocks. S&P dropped 50% 2002. The NASDAQ dropped 82%. So NASDAQ 100 will be the leader on the downside as well, but it hasn't broken our structure yet. But we think when it does, and you start to feel the jolt and the what's going on comments, that's when you'll see more of that money flow into gold. And that's when I think it will be, as I call it, the wet bar of soap time. Everybody grabbing for it.
No, a lot of people are.
I think that would be soon, too.
A lot of people are obviously eyeing the 3,000 level. Do you think that is significant, and could that maybe be the trigger for all of this?
We pointed out in August of last year, a couple months after our breakout in March, that likely there would be price chart type selling around 3,000. Well, one, because it's a round number, and we know idiots love round numbers, so they like to play round numbers, okay? Like $200 gold back in 1975, happened to be a round number. Now, the 1980 peak wasn't a round number, but anyway, they think 3,000, it's a nice big round number. And so you had 3 weeks of selling at that same level, just below, 0.5% below 3,000. And we said there might be some resistance there. And I think it will be the type of resistance we've just seen, which is to say, ho-hum resistance, just pause. And when you go through that, people say, well, where's it going? And all these big brokerage firms that analyze gold that we see reports from, they have a target of, about 3,000. And suddenly they change, 3,100, but 3,300, and they keep raising it. But it's sort of silly. They don't realize that even if you just look in the past, over the last 50 years when gold was legalized in the U.S., there have been 2 moves that were at least eightfold. And there were different time durations. One took 3.5 years, 1976 low to 1980. And one took 11 years from 2000 to 2011. But there are eightfold moves. Well, if we had an eightfold move, we'd be $8,000 gold. And we're not projecting that as a target. We're just pointing out the fact that gold has done this before. It's no big deal to do it again, especially given the fundamental factors that are in play and becoming more in play now in the world and in markets and so forth, especially when bubbles break, because then money does flow elsewhere.
There's a secret signal that has predicted every major silver bull run in history, the gold to silver ratio. This simple metric measures how many ounces of silver it takes to buy 1 ounce of gold, and right now it's flashing one of the biggest buying signals we've ever seen. Historically, when this ratio reaches extreme levels, silver doesn't just rise, it explodes. Let's look at the numbers. Over the past century, the gold to silver ratio has averaged around 50 to 1, meaning it typically takes 50 ounces of silver to buy 1 ounce of gold. But during times of crisis and major financial shifts, that ratio has collapsed, sending silver on parabolic runs. In 1980, as inflation spiraled out of control, the ratio plunged from 40 to 1 to just 16 to 1, triggering silver's legendary surge to nearly $50 an ounce. In 2011, as the financial system struggled to recover from the Great Recession, the ratio fell from 80 to 1 to 30 to 1, fueling another silver breakout to $49. And today, the ratio has been hovering at extreme levels, well above 80 to 1. At its peak in 2020, it even surpassed 120 to 1, marking the most undervalued silver had ever been relative to gold. This tells us one thing: silver is overdue for a massive revaluation. Because every time this ratio has corrected, silver has delivered explosive returns, outpacing gold by multiples. But here's why this time could be even bigger. Unlike past cycles where silver's price movement was primarily driven by monetary and investment demand, we now have a perfect storm brewing. Industrial demand is soaring, supply is tightening, and the market is asleep at the wheel. The gold to silver ratio isn't just a historical anomaly. It's a flashing signal that silver is about to play catch-up in a way that will leave most investors stunned. The window of opportunity is still open, but it won't stay that way for long. Because when silver finally moves, it won't just rise gradually. It will break out with a speed and intensity that catches the entire market off guard. And history tells us exactly what comes next.
That's a point of commentary among a lot of analysts, and I don't disagree that it probably indicates something about futures contract deliveries and so forth and so on. But we sense and know from what we've read that especially U.S. investor interest in the gold miners has never been so low in history, okay? And their capital commitment and their leverage in the U.S. stock market has never been so high, okay? So they're highly vulnerable to breakage in their stock positions because not only are they long, but they're like triple long. They're using a lot of leverage, more so than ever before. And therefore, there's vulnerability there. And when you look at the gold miners, both in when we measure like the XAU or GDX versus gold, or XAU GDX versus the S&P, we see the same situation. They're very low. They've not been going lower in relative terms. despite the public sense that they have. They've not. They've really held their ground. In fact, XAU index from December 2015 to the present is actually up more than S&P is from its 2015 low price at December 2015. So nobody believes that, but it's a fact. We think that could shift. And when it does, because of the tiny nature of the gold mining sector, it would be a panic situation. It'll just change the nature of the behavior of the gold miners in terms of volatility, upside, and so forth, which will shock a lot of gold investors because who are in the miners, who are more or less bored to death by them or scared to death by them every time they dip. But I think that's the reality that's about to dawn. And I think just watch the mama market gold. If the gold goes up and goes through 3,000 and takes out that silly high, then it's telling you this is another BS sell-off. We've had like 6 or 7 of them in the last year, and they don't amount to anything. And $3,000 is an idiot level. Okay, and we're going to accelerate. And I think for silver, I'm using May contract now, which is a 32.40 area. You get much above 33 again, I think silver is going to start to accelerate. And if you look at the gold miners, just a simple monthly price chart, not momentum, just go back to the 2015 low and look at XAU and look at GDX. Over the last 3 years, they keep coming up to the same general level, which is a flat ceiling. XAU, for example, is trading either side of 160. If you go back 3 years, you'll find that there's like 5 or 6 monthly closes. There are a couple percent either side of 160. That is not a top, folks. You do not top a market that way. When you top a market, you generally peak it, drop, and you can't get back to the high. You keep coming back to the high indicates, no, that's a launch pad. And I think that's about what's going to happen here.
For years, silver prices have been artificially suppressed by the same institutions that stand to lose the most when it finally breaks out. The big banks, hedge funds, and institutional traders have been shorting silver heavily, keeping prices lower than where they should be. But here's the problem. When you suppress something long enough, the pressure builds. And when it finally snaps, the move is violent. That's exactly what's setting up in the silver market right now. Let's break this down. The silver futures market is built on leveraged contracts, paper silver that far exceeds the amount of actual physical silver available. Big players like JP Morgan and other major banks have been using these contracts to keep silver prices contained, making massive profits by betting against rising prices. But the cracks are forming. In recent years, retail investors have been waking up to the silver manipulation game. The silver squeeze movement in 2021 was just the beginning, when thousands of investors tried to buy up physical silver to force a price spike. It worked, briefly, but the real squeeze hasn't even started yet. Because this time, the pressure isn't just coming from retail investors, it's coming from central banks, industrial buyers, and sovereign wealth funds. Big players who need real, physical silver, not just paper contracts. And here's where it gets explosive. If too many investors demand physical silver at once, the paper silver market could collapse, triggering a massive short squeeze. The banks that have been betting against silver would be forced to buy back their positions at any price, fueling a surge unlike anything we've seen before. This is exactly what happened in the past. In 1980, when the Hunt brothers attempted to corner the silver market, prices spiked from under $10 to nearly $50 in just months. In 2011, silver shot up to $49 again as demand overwhelmed supply. But this time, the setup is even more extreme. Silver is already in a supply deficit, industrial demand is skyrocketing, and the gold-to-silver ratio is at historically high levels. The moment the market realizes how tight the physical silver supply really is, we could see a buying frenzy that forces silver to reprice overnight. The big institutions don't want this to happen. They've kept silver under wraps for decades, but the cracks are widening. And when the short squeeze finally comes, it won't be a slow climb. It will be a vertical explosion. The question is, who will be positioned before it happens? Who will be?
NASDAQ 100 again because it's our leader. And there's certain sectors out there that seem to be defying the drop we're seeing in the tech leadership. The Magnificent Seven are dropping now, whereas financials, for example, are making new highs, XLF ETF. We think that is a trap. We think it's a exhaustion spike in the financials that will fail. But also, I think it's probably driven by a false assumption, and that is, oh, good, long rates are starting to drop. Well, the reason for the long rates starting to drop is probably not good for the stock market. It's indicating an asset flow into a, quote, alternative sector, which has historically, go back especially the last couple of bull market peaks and bear markets, have risen while the stock market went down because investors and asset managers moved there as a place of safety. And I think that's what's helping cause the T-bond market to rally of late, is the beginning breakage that we're seeing in the stock market. So it's really not a positive thing. And plus, in the past, whenever rates start to drop, it's too late. The bubble's already broken. Every time, 2000, 2002, 2007 to 2009, rates collapsed. Fed cut rates like crazy. It didn't help.
If silver prices explode, the biggest winners won't just be those holding physical silver. History shows that silver mining stocks have the potential to deliver life-changing gains. When silver runs, miners don't just follow the trend. They amplify it, often skyrocketing by 500% or more. And right now, many of these stocks are sitting at ridiculously low valuations, creating an opportunity that few investors are paying attention to. Let's look at the past. In the 1970s silver bull run, while silver soared from under $2 to nearly $50, top silver mining stocks delivered gains of 1,000% or more. Then in 2011, as silver spiked to $49, miners followed with explosive moves. Companies like First Majestic Silver, Pan American Silver, and Wheaton Precious Metals saw massive surges, with some rising 400% to 600% in just a few years. Why does this happen? Because mining stocks act as leveraged bets on the underlying metal. When silver prices rise, the profit margins for miners expand exponentially. A mine that was barely profitable at $20 silver can become a cash printing machine at $50 silver. And when silver demand skyrockets, companies that own rich silver deposits suddenly become some of the hottest investments on the market. Right now, many silver miners are severely undervalued. Years of low silver prices have forced companies to cut costs, delay projects, and underinvest in new production. But with silver's breakout on the horizon, these companies are poised for an explosive reversal. We're already seeing signs. Investors are beginning to rotate into mining stocks, and as silver prices push higher, these stocks could move at multiples of silver's gains. But here's the catch. When silver miners start to take off, they move fast. During past bull markets, many mining stocks went from overlooked to overbought in a matter of months. That means the biggest gains will go to those who position themselves before the breakout. The institutions and hedge funds aren't waiting. They're already increasing their stakes. The question is, will you be ahead of the curve, or will you be chasing after the move once it's already begun? Because once silver rips higher, the biggest fortunes won't be made in the metal itself, but in the companies pulling it out of the ground.
If you look at it carefully, it will swing better than gold and then swing worse than gold. It's more volatile. So there's some up moves. For instance, when gold was capped at 2,400 for several months, silver wasn't. It went from like 31, 32 up to 35. And gold didn't go through the 2,400 zone, and yet silver did. So it exceeded gold then. And then in pullbacks, invariably, silver will underperform gold. We're watching the spread relation between silver and gold and the miners and gold. And technically, we're watching it. And we see on the spread charts trend structures such that if you get in the next few days or weeks, even modest outperformance by the miners to gold and outperformance by silver to gold, that you're going to break those spreads out of a process of correction that's been going on in those spreads since mid-2020 to 2021 highs, when silver outperformed gold and the miners outperformed gold. Since then, they have corrected on a performance basis, and they've got breakout levels not far above, and where at levels you won't notice just looking at their price charts. This is a spread relation, don't look at their price charts, that indicate upside resumption. And this is what happened, for example, in silver. in the 79 to 1980 move, the last year of that bull market, and also in the 2010 to 2011 surge, which is the last year or so of that bull market, silver vastly outperformed gold. It's like exploded. We think that the miners in particular have demonstrated over the last 10 years, since the 2015 bear low, if you look at their spread chart versus gold, they're actually at a higher level than they were then. Now, it's still at a very low range historically of the miners versus gold compared to where they were, for example, back in prior to 2009. They were much higher relative levels. But it's a base, and they've not gone back to the low of that base. Now, what does that mean? It means they've demonstrated over the last 10 years, we're not going to underperform gold anymore. And sure enough, that spread relation, if you take the current reading of the spread, it's higher than it was at the 2015 bear low. So their underperformance to gold ended then. And since then, yes, they've gone range bound in performance to gold up. And
While most investors remain fixated on stocks and crypto, the smart money is making a different move into gold and silver. The biggest players in the market aren't waiting for the headlines to tell them where to go. They're already positioning themselves for what's coming. And if history is any guide, those who follow their lead before the masses catch on stand to reap the biggest rewards. Look at what central banks are doing. In 2023 and 2024, they purchased record amounts of gold, signaling that the institutions running the global financial system no longer trust their own currencies. China, Russia, and India are leading the charge, aggressively accumulating gold reserves while simultaneously reducing their exposure to the US dollar. This isn't speculation. It's a deliberate move to hedge against a looming financial crisis. And then there's silver. While central banks don't traditionally hoard silver like they do gold, the industrial sector is absorbing silver at a record pace. Meanwhile, billionaires and hedge funds are quietly increasing their silver holdings. The world's richest investors understand one thing: when fiat currencies weaken, when debt spirals out of control, and when inflation erodes purchasing power, precious metals are the only assets that truly retain value. The crypto market is already flashing warning signs. After years of dominance, Bitcoin has stumbled, dropping 27% from its all-time high, while investors pull billions out of Bitcoin ETFs. Meanwhile, gold and silver ETFs have seen massive inflows, a clear indication that institutional investors are reallocating their wealth. It's a pattern we've seen before. In 2008, when the financial system was on the brink of collapse, those who rotated into gold and silver early saw historic gains. In 2011, when silver hit $49, those who had positioned themselves beforehand made fortunes. Now, all the signs are pointing to an even bigger move ahead, and the biggest players are already making their move. The question is, will you act before the crowd catches on? Because once the financial system fully cracks, once inflation spirals beyond control, and once gold and silver become the only safe havens left, the opportunities we see today will be long gone.
down, but what you call a par performance, but they're actually higher net price-wise, measuring from the 2015 low to their current price than gold is relative. For instance, XAU index as of last week's close was 3 times its low of 2015, whereas gold is 2.7 times its low in 2015. So actually XAU index, which is still at very low levels in relation to gold, is been outperforming gold. Minor amount, but outperforming. Nobody would believe that. They think, oh, it's underperforming. The question is, if you could break it out of this basing pattern on the spread, we think gold miners could triple their current relative performance to gold over the next year or so. In other words, if we enter an acceleration phase in the net price of the monetary metals, we think we're also going to see silver outpace gold. You get up to more or less normal levels, like 2% of gold, whereas right now it's 1.12% of gold, which means a doubling in its value to gold. And the gold miners, we can give you an example. Gold mining, XAU versus gold is like about 5.5% of the price of gold. You go back to the 1980s through 2006, 2008, its low spread rating was 17.5%. It had been in a range between 17.5% and 35% of the price of gold, and it collapsed in 2015 to 4% of the price of gold. That's like free, okay? I mean, it's not going to zero, okay? And it's now 5.5%, so it's higher than it was then. But if you take it from its current level and run up to the bottom side of that multi-decade relative performance and bump the floor, the old floor, it's a tripling in the current value of the miners relative to gold. And we think that is very realistic. What does that mean? It means the money flow out of the stock market doesn't rush into silver futures or gold futures. It goes into miners. Miners are cheap. That's a virtue. They've proven they're not going down anymore. And on a relative basis, they've got a lot of dynamic potential on the upside. And I think the money from stock market longs will move into gold mining long positions.
This isn't just another market cycle. It's a fundamental shift in the financial system. The warning signs are everywhere. The stock market is walking on thin ice. Debt is spiraling. Fiat currencies are losing credibility. And the institutions that once propped up the system are now quietly preparing for its next phase. Gold and silver aren't just hedges against uncertainty anymore. They're becoming the foundation of the next era of wealth. And the smart money knows it. Central banks are hoarding gold. Billionaires are accumulating silver. Institutional investors are rotating out of stocks and crypto into hard assets. Meanwhile, industrial demand for silver is surging. Supply deficits are widening, and mining stocks are still sitting at historically low valuations. All of this is setting up for one of the biggest wealth transfers in history. The last time silver made a parabolic move, it went from under $10 to nearly $50. But this time, the setup is even more extreme. The gold-to-silver ratio is screaming that silver is undervalued. The short positions in silver are stretched to a breaking point. And when the squeeze finally comes, prices won't just rise, they'll launch. This is the moment where decisions matter. When silver breaks out, it will move fast, and those who wait for the headlines will already be too late. The institutions aren't waiting, the billionaires aren't waiting, the central banks aren't waiting. The question is, will you? If you found this discussion valuable, be sure to subscribe to stay ahead of the curve. And remember, this is not financial advice. Always do your own research and speak with a professional before making any investment decisions.